I'm joined now by Jack Ablin, Chief Investment Officer with Harris Private Bank. Jack, always great to see you.
Thanks, Laurie.
Okay, so safe to say basically that the U.S. markets have shrugged off the Dubai debt crisis?
Yeah, I would say so. I was encouraged by trading on Friday, although it was very, very light volume. Keep in mind, Laurie, that going into Friday, we were obviously closed Thursday, that the major world indices were down about 2.25%. So that was already baked into the cake. The fact that we dropped only 1.25 suggests that we were actually, I view that as a positive 1% from that point. We're seeing some follow through today. Certainly the Purchasing Managers Index released this morning was strong. But I also think it's just an indication that right now, knock on wood, that this Dubai situation is isolated there, that it seems Abu Dhabi will come in and support in some way to mitigate the damage there. And, and even then, I think Hendler, said, I mean, most of the risk in the U.S. is pretty limited.
But isn't this the question of the day right now that we've had a couple of days to digest this and we're watching all the wheeling, dealing, or how they're going to manage this debt, that it's getting people to start thinking about their own risk positions, and maybe they'll start profit taking some of that risk off the table, even deleveraging some of their own debt?
Well, that's it. I think at some point it's going to force investors to start to look, at their risk exposure. I mean, it's remarkable to me that virtually all equity markets are up pretty much, in one correlation of one, and really just in magnitude of risk. And so at some point now, as valuations are starting to get full, investors are going to start to take a harder look at their markets and say, you know what, the emerging markets are trading currently at a valuation premium to the U.S. Is that really sustained? I will say that there have been 3 occurrences in the last 20 years where the emerging markets traded at a valuation premium to the S&P 500, and each of those times the emerging markets underperformed the U.S. by over the next 12 months by some amount.
And getting back to U.S. market, stocks are a little weaker today. A lot of people pointing to the consumer, a little weaker than expected performance for the retailers over the holiday shopping weekend. But do you think that the U.S. rally could now be weakening?
Well, it's entirely likely, Laurie. The fact is that valuations are full. There are certainly a lot of expectations built into current valuations, and the technicals have been really driving the market recently. Here, I think the market will tend to move higher unless we get strong enough evidence against that, and I haven't seen anything strong enough to say, this is going to be, stand in the way of future gains. I will also, point out that if Monday today is Internet Monday, where we're going to see a lot of the Internet sales, I did notice anecdotally that most of the best deals that retailers are offering in store, I mean, having to get in line at 5 a.m., are also available on the web. So my sense is that, given the choice, get up and stand in line at 5 in the morning or just point and click and buy something online, that we're going to see more deals and more revenues mapped over to the web. But, that remains to be seen.
Jack, I want to ask you a little bit more about risk, because in reading some of your comments, zero-rate T-bills, you point out, are prompting worldwide risk-taking. Yet we had this earlier part of the conversation saying, well, gosh, what's going on in Dubai might make people think twice about their risk. But again, maybe I'm answering my own question here. That risk is overseas emerging markets, commodities too, perhaps.
That's it. And clearly we got to a point earlier this year, late last year, Laurie, where, it made total sense to take on risk. The fact that values were just incredibly cheap by multi-decade standards. We had that, plus a little momentum, really got everyone in sometime in the first or second quarter. And that's really, in many respects, run a lot of its course, certainly most of its course. The easy money's been made, and now we've got full valuations with, I'm going to say full expectations built in. And so now the question is, are those 0% T-bills still enough to prompt people to continue to take risk, knowing that the Fed will likely be sidelined for most of 2010?
Would you recommend?
And I think that's, go ahead.
Sorry. Would you recommend paring back stock exposure then?
At this stage, no. I mean, the fact is that it was valuations plus momentum that got us into the market. Valuations certainly are full, and momentum is clearly very strong. So I'm going to wait for momentum to break down and the technicals to erode before I pull back. So we're still overweighted in equities. We're going to continue to ride that wave if we can.
And there's your advice from Jack Ablin of Harris Private Bank. Thanks as always.